students, let's revise this topic, admission of partners. I have covered only journal entries here. Admission of partners, journal entries. When the new partner comes into the business, he brings money. So when he brings money, debit what comes in, credit what goes out. As per that rules, cash is coming, so cash is debited. And new partner is bringing the money. Debit the receiver, credit the giver. Therefore, our entry is cash account debit to new partner's capital if he's bringing money. And second, if he's bringing assets in place of money, say for example, plant and machinery, stock. So in that case, we will say plant and machinery account debit to new partner's capital. Entry number 1 and 2. If cash is coming, you will say cash account debit. Entry number 2. If assets are coming, you will say assets account debit. Because real account rule says debit what comes in. And who's bringing that? The new partner is bringing. So our entry is cash account debit to new partner's capital. Second, assets account debit to new partner's capital. Third, reserves appearing in the balance sheet before admission belongs to the old partners because they have earned it. Same as with the losses. And you know very well, reserves means profits. And you also know very well, reserves have credit balance. So how to close that reserve? In order to close any account, you are going to give opposite effect. Now, what do I mean by this? When a debit has to be closed, I will credit it. When a credit has to be closed, I will debit it. So, when I'm distributing my reserves, when I'm finishing off my reserves, I'm going to finish off my reserves. I'm going to close my reserves account. Reserves have credit balance. How to close it? Debit that. That belongs to the old partners. I will say reserves account debit to old partners. Losses have debit balance. I want to close it. So how I'm going to close it? I'm going to credit it. So I will say old partners capital account debit to P&L. Next is goodwill. Here basically for goodwill there are 2-3 cases. One is goodwill brought in cash, one is goodwill raised, goodwill already appearing in the balance sheet, and one last case, private settlement of goodwill. So let's take goodwill point one by one. Goodwill brought in cash by new partner. Remember, whenever the new partner is bringing goodwill, he will bring only his share of goodwill. So when he is bringing money, cash account debit to goodwill. And that goodwill will go to the old partners because it is their goodwill. And remember, that will always go in the sacrifice ratio. What is sacrifice ratio? Sacrifice ratio, see below the slide it is given. Sacrifice ratio is old ratio minus new ratio. And if new ratio is not given in the question, then sacrifice ratio will be equal to your old ratio. Cash to goodwill. Goodwill account debit to old partner's capital. The credit for this money will not go in the new partner's capital. The credit for this money will go in the old partner's capital because this is not the money for the new partner he's bringing. He's bringing the money as goodwill. So first entry, cash to goodwill, and that goodwill will go to the old partners in the sacrifice ratio. Remember, sacrifice ratio is used only in this case. Nowhere else you're going to use the sacrifice ratio in this topic. Sacrifice ratio comes only when goodwill is brought in cash by the new partner. Sometimes what happens, they say in the sum, goodwill is brought in cash by the new partner, then it is withdrawn by the old partners. So when goodwill is brought in cash, two entries are same, cash to goodwill, goodwill to old partners. And when the old partners withdraw the money, money goes out of the business. So entry is old partners capital to cash. That is the extra entry we make in the sixth transaction, apart from goodwill brought in cash. And see, I have put the asterisk marks and I have written in both the cases, in fifth transaction and in sixth transaction, goodwill is not going to come in your balance sheet. Goodwill is not going to come in your balance sheet because During lectures, when we solve sums, children have this confusion. So in this itself, I have covered it. So goodwill will not appear in the balance sheet. Reason you can see, goodwill is credited in the first entry and goodwill is debited in the second entry. In both the cases, in fifth as well as sixth, the goodwill get cancelled. Seventh is goodwill raised. This goodwill belongs to the old partners. Therefore, entry is goodwill account debit to old partners capital. Asset, goodwill is an asset. Assets have debit balance. You're bringing the asset into your books. So our entry is goodwill to old partners. It will go in the old ratio. And sometimes they say goodwill is written off. Eighth case, goodwill raised and written off. So goodwill raised entry is same, goodwill to old partners. And goodwill written off journal entry is all partners capital to goodwill. All partners capital to goodwill. Written off means you're reducing the balance of goodwill. So how to reduce the balance of goodwill? Credit that. So all partners capital to goodwill. Here it will go in the new ratio. Why we make this? Because the new partner is not in a position to bring in cash for goodwill. So we give extra credit to the old partners when we raise the goodwill. And we give a debit to the new partner when we write it off. In both the cases, you remember goodwill will appear in the balance sheet in seventh case, and in eighth case, goodwill will not appear in the balance sheet. See, in the seventh case, goodwill is only debited. See, in the eighth case, goodwill is debited and goodwill is credited in the next entry. Therefore, goodwill will not appear in the balance sheet. And sometimes in the question, goodwill already appears in the balance sheet. In that case, there are many treatments. The treatment which I am going to follow is I am going to treat it like any other asset. So I will see what is the value of goodwill in the balance sheet in the asset side. I'll compare with the adjustment value. If the value is increasing, I will say it is profit. So I will say goodwill to revaluation. And if the value of goodwill in the balance sheet is say 10,000 and in the adjustment it is 8,000, that means the value is reducing. So if the value of goodwill is reducing, it is lost. So in that case, I will say revaluation account debit to goodwill. See the asterisk mark, goodwill will appear in the balance sheet at the revalued figure. And in some cases, they say in the sum, there is private settlement of goodwill. If private settlement of goodwill is made, remember, there is no entry. This children, when I taught you in the class, I gave you a detailed description. If value of asset increases, I have taught you as it is profit. If value of asset decreases, I taught you it is loss. Liability increases, it is loss. Liability decreases, it is profit. I hope you remember that. And assets have debit balance. If you want to increase the asset, increase the debit. If you want to reduce the asset, credit the asset. Otherwise, if there is profit, revaluation credit. If there is loss, revaluation debit. See 10th transaction. Increase in value of assets, assets to revaluation because it is profit, therefore revaluation credit. Decrease in value of asset, there is loss, revaluation debit to assets. Increase in value of liabilities, it is loss for you. So revaluation account debit to liabilities. Decrease in liabilities, it is profit for you. So liabilities account debit to revaluation. And then at the end, we'll close the revaluation account and that balance is going to go in the old partners capital. Revaluation account debit to old partners capital or reverse old partners capital to revaluation account. These are the common entries which come in the sum. Now next slide onwards are the adjustments which comes rarely. It comes rarely. I'm not telling it doesn't come in exams. You have to prepare for it also. Assets taken over by partner. Assets taken over by partner, they tell you plant and machinery is taken by X, building is taken over by Y, like that. So you have to see whether it is taken over at same value, higher value or lower value. In case if asset is taken over at higher value, that means asset of 10,000 is taken for 12,000. That means assets value increases. So it is profit for you. So you will say respective partners capital means the partner who's taking the asset. He is a receiver. Respective partners capital account debit 12,000 to asset account 10,000 to revaluation account 2,000. Now lower value. Assets value is 10,000 and say it is taken over for 8,000. So there is loss. I will say respective partners capital 8,000, revaluation account debit 2,000, to assets account 10,000. And last case, asset is taken at same value. The asset is worth 10,000 and it is taken for 10,000. So my entry will be respective partners capital to assets. So basic entry, when partner is taking over asset, partner is the receiver, debit the receiver, and asset goes out. Debit what comes in, credit what goes out. The basic entry is partner's capital to assets, and in between you have to adjust for the profit or loss. If asset value increases, it is profit. You can see 15th transaction, first case, revaluation is credit because there is profit, asset value increases. 15th entry, second case, asset is taken at lower value. If asset value decreases, it is loss, so revaluation account is debited. Liability taken over by partner. When partner takes over an asset, he is the receiver. When he takes over the liability, he's the giver. Debit the receiver, credit the giver. So you can see in this entry, partner is credited. So when he's taking over the liability, our entry is liability account debit to respective partner's capital. Suppose 10,000 liability is taken over for 10,000, our entry is liability to partner's capital 10,000. If 10,000 liability is taken over for higher value, so it is lost for us. Liability account debit 10,000, revaluation account debit 2,000, to partners capital 12,000. Suppose the liability is taking over for 8,000, 10 liabilities taken for 8. So my entry will be partner liability account debit 10,000, to partners capital 8,000, to revaluation account 2,000. And same value, liability to partners capital 10,000. Reserves are transferred to RDD. Reserves have which balance? Credit balance. How to close it? You're going to debit it. So my entry is going to be general reserve to RDD. So remember the points in this case. If RDD is created from general reserve, it is not going to affect your evaluation account. And when you distribute to the reserves to the old partners, you are not going to distribute the reserves to the old partners entirely. You have to see how much is transferred to RDD. So whatever is transferred to RDD, that will not be given to the old partners. Now how I'll explain this. I'll take one example. There is reserves of 12,000 rupees. So they are telling in the adjustment 50% reserves is transferred to RDD. So I will say general reserve to RDD 12,000 into 50%, that is 6,000. So my entry will be general reserve to RDD 6,000. And then when I distribute the reserves to the old partners, I am not going to give them 12,000. I'm going to give them the remaining 6,000. From where I got the remaining 6,000? 12,000 was there, 50% was transferred to RDD. So remaining 50% I'm going to give to the old partners. Post-date capital adjustment is given in the sum. They give you instructions where the balance has to be transferred: cash, bank, current account, or loan account. So as per the instruction, you will transfer the balance to the given account. Sometimes they will say current, so you are going to say partners capital to partners current. If they say loan, so you will say partners capital to partners loan. Or they will say cash or bank, so you will say partners capital to cash or bank. So accordingly, the entry can come partners capital to partners current, or partners loan, or cash or bank, or it can come reverse also, depending upon the amounts mentioned in the sum. So that's all. We have revised the topic admission of partners. Journal entries only is covered in this presentation. I hope you all will revise it. You will go through it. And if you have any doubts, you can call me. Thank you.